All right, so everyone, welcome to our second investment meeting. Thanks for coming. If you can, turn your cameras on. We're going to try to make this as personable as possible. And let's kick things off with an agenda. So we're going to do introductions. Not everyone has to go again. We'll just do the new people that are here. Sko is going to give a market update. We have a really exciting guest speaker, and then we'll introduce him. We'll go through our 3 levels, like we mentioned in our first meeting. Beginner will be the easy stuff, kind of just to get you going, intermediate, and then our advanced guest speaker will take over. And then we'll have a discussion where people can ask questions to him, ask questions to anyone else on the panel or whatever. So that'll just be open. And then closing we'll do of what next month's meeting will look like. So without further ado, let's do introductions for new people. How this works is kind of just, we're going to put you on the spot here. You just say your name, where you graduated, where your occupation is, and why you're here, or what you expect to get from this group. So let's start with Camille or Ross Klein. If you guys are able, if your mics are on, give us a brief introduction and start it off.
Wonderful introduction there, Anna. Can everybody hear me?
Yep.
Cool. So my name's Ross. Camille's downstairs doing things for the family, so I don't know if she'll hop on for this one. Oh, there she goes. Graduated from MSU, CPA, and I am looking to see what the world is doing with their money, because I primarily do stock market. I assume that's what we'll be talking about, but I'm a newbie, so we'll see. But I know real estate and some other, joint venture type projects are out there. So just looking to explore the options, building wealth.
Cool. Thanks, Ross. Maybe we'll hear from
I'm Camille, and I'm
Camille. All right, cool.
Big spiel, I guess. I graduated from MSU, and I'm a CPA for Plante Moran, just like Ross. And even though I'm an accountant, I think finance was probably my worst class in terms of grade point. So I'm more here for the basics. But no, thanks for the invite, and looking forward to learning a little bit. So
awesome. Well, thanks for being here. We are going to move to, looks like we only have one other that has joined, which is Luke. Luke, you're on if you're able to.
Hi, everyone. I'm Luke Van Ness. I'm on my last year here at MSU. I'm a data specialist for MSU RHS, sorry. And I'm pretty new to everything finance, so I'm just here to learn.
Cool. Well, we'll definitely have some beginner material, as I'm in the same boat. So, all right, let's move on with Jode with the market update.
Okay, can everybody hear me?
Yep.
Okay, the market updates will typically cover what's happened in the previous month, as these are monthly meetings. We'll briefly touch on what's happened in 3 market indexes. Those are the Dow Jones Industrial Average, the S&P 500, and the NASDAQ. Those are usually the most popular indexes that people look at. And then we'll touch on other events, where there are major IPOs, major acquisitions, macro market events, for example, like today, but we'll cover that in a minute. And then sometimes we'll do a fun update in there just to keep it lively. So I'll just cover the indexes for those who don't know about them. The Dow Jones Industrial Average started in 1896. There's only 30 companies from some different sectors. It's one of the most followed just because of the length of time it's been around. Its performance is about 5.4% since inception, which again, that's a large span of time. So there were many different bull and bear markets during that time, but on average about 5.4%. What it's good for is mainly conversation. You hear a lot, oh, the Dow was up 500 points today or down 500 points. And then some of the shortcomings are it only includes 30 companies. So doesn't accurately represent the entire market, and it's weighted by price, not size. So that can also be seen as a shortcoming. Then we have the S&P 500, started in 1926. That's got 500 of the largest companies. This is actually weighted by size. And as you can see, there's a little note that the largest 10 companies make up 26%. You must be invited, which is kind of the same for the Dow, but there's a case recently, Tesla, they were a US company. They had the market cap size. They had consecutive profitable quarters, but the S&P deemed that their share price wasn't reasonable because it was inflated so much. So ultimately they got the snub, and that was just a few months ago. So I figured I'd include that example. Then we have the NASDAQ, which is the newest of the three. It's also weighted by size and includes a larger group of companies. It's more tech oriented, which makes it in turn more volatile. But due to the recent surge in tech, it's performed at about 12% annually since inception. So for this market update in particular, I'm just going to cover what's happened over the last what's happened year to date, obviously with coronavirus tanking the market in late February, early March into early April. I'll just cover kind of how each of the indexes has recovered. As you can see, the Dow here, it's hasn't quite fully made it back to where it was pre-COVID. And it's typically comprised of more not value companies, but slower growing companies. So it hasn't quite made it back to even. I don't know. You can go to the next slide, Anna. We have the S&P 500, so almost looks like the exact same graph, except it's pretty much recovered since COVID. And then the final one, the NASDAQ, it's had the greatest recovery. It's obviously more tech oriented, so it's kind of actually thrived post the initial drop. And then Anna, you can go one more. Some more details. Right below that is percent return from the Corona lows. So as you can see, what we kind of just saw, the NASDAQ has rebounded the best, and there's another visual representation of that on the right. 100 would be the base, which would be 1 year ago from the start of October. So you can see the big crash in early 2020, and then how the indexes have since recovered since then. And this recovery has come through a slew of different things, specifically the Fed lowering the federal fund rates. They also announced security purchases. They've been lending to employers and small businesses, lending to states and local governments. We had the cash disbursement to citizens. That was that $1,200 that most people got. And then this note was added before this afternoon, where it said more stimulus on the way. Today, Trump announced that they would not be looking at stimulus until after the election. They're going to focus on hiring the new Supreme Court justice. So the market actually took a 400+ point hit from that announcement. And then there's a good resource down there if you want to look up more of what they've done to combat COVID financially. And then we have Fat Bear Week. So some of you might know a bear market is a market where there's negative growth or almost zero growth. So there's also a competition of which bear is the fattest, which actually concludes today. So you can go submit your vote. Right now we have 747 facing Chunk, and it should be a good vote. So I urge you to get out there and vote for 747 or Chunk. I think we have till 10 o'clock. So does anyone have any questions on those things I covered there?
All right, well, I guess we'll move on then.
Now we're going to get into some basic accounts for employees and individuals to use for investing. If you're working at a company, they often offer a 401k. The biggest difference is a Roth or traditional. So the benefit of a Roth is you get taxed initially when you put your money into the account. When it grows tax-free. So your earnings on everything are tax-free when you pull them out at 59.5. Then you have a traditional where you're not taxed when you put your money in, so it goes in at a higher basis, and the taxes are deferred, and then you're taxed on the principal, so what you put in plus any gains when you pull the money out, and it's at 59.5 as well. So the biggest kind of thing to think about between those two accounts is if you think you're going to be making more money, or if you think you're going to be in a higher tax bracket or taxes are going to change to be higher in the future, then a Roth would make more sense. If you think that
Oh, Huey, I think you just got muted. Can you Okay, you're good.
Did you hear what I was saying initially or no?
Yeah, you could.
Okay.
It was just that last part.
And then if you think taxes are going to go down in the future and or you're going to be in a lower tax bracket when you retire, then a traditional might be a good play for you. With both of those, they're both 401ks and they're offered through a company, so you have to be earning income. So if you're in school or younger, it might not be an option for you. You can put in $19,500 between the two. And then you must pull distributions out at the minimum required rate, which is a calculation that the SEC does at 72. If you're over 50, you can put in extra catch-up contributions of 6,500 on top of the 19,500. Some benefits are companies sometimes match. Most companies in the US fortunately match. So if anyone's just starting out, definitely a thing to always make sure you are getting your full match. It's just free money. And then there's also, yep.
Hey, Hugh, I have a quick question.
Yep.
Could the government ever change the age and when you can withdraw tax-free, so that 59.5 number?
I believe they can. And if I'm pretty sure they can. Do you know or does anyone in the group know? Maybe Ryan can jump in on this one.
They likely could. I don't believe that age has ever changed. The age that has changed is the minimum distribution age. So the age that you have to start taking RMDs. For a long time, it was 70.5. And the government, as part of a tax act at the end of last year, basically pushed that age a year and a half later to 72 so that you could keep your money in a little bit longer without having to take that minimum distribution. So there's always a chance that they could change that age, but I don't believe it's happened in many years. And I don't think that's typically something that's on the table for tax changes, but it is possible.
Thank you. Thanks for the question. Yeah, and as we're going through it, please ask questions. So then there's a Roth and a traditional IRA. So it's the same concept of what I described between a Roth and a traditional for how they're taxed and the benefits of each. The main difference is an IRA is personal. It's not through an employer. So you still need to be earning income, and you can put in $6,000 a year between a Roth IRA and a traditional IRA. And then if you're over 50, you can put in an additional 1,000. If your company offers a 401k, you can currently still contribute to an IRA and a 401k. And then the interesting thing, or the benefit of a Roth IRA, is that you can withdraw your principal at any time, tax-free and without penalty. So this is really big for younger individuals that are maybe buying a house. they can invest their money and pull it out. I wouldn't advise ever pulling your money out, but it's just a thing that if you're worried, like, hey, I might need this in the future, the Roth IRA is one option where it does allow you to do that, which is pretty rare with investment accounts. And then, wait, Anna, can you go back up? And then you have your taxable account. So this is for any purpose. It's personal use. The benefit is you don't need to earn income. So you can, put money in regardless if you are earning income. Money is not necessarily taxed when you put it in if it's from your bank account, but your income that you make to get the money in the bank account is taxed. Each year it's dividends and interest and capital gains are taxed. And then when you withdraw your money, you're taxed. If it's greater than a year, you're taxed between 1% and 20%, and that's based on your tax bracket. It's called the capital gains rate. If it's less than a year, you're taxed at ordinary income. And you won't get taxed, obviously, with capital gains unless you actually sell the stock and recoup those funds. A benefit of this is there's low barriers. So it's like Robinhood. A lot of people use Robinhood or different accounts like that. You can easily jump in and jump out, and you can pull your money out at any time, but it doesn't have the same benefits. You can also elect for your IRAs or 401ks to be self-directed, which allows you to put money in real estates, gold, privately held companies, but that's, a little bit more complex, and I would advise getting a professional if you're going to do something like that. But there is an advantage of potentially more gains and naturally potentially more losses. This is for business owners. So I know some people here are business owners, whether it's, they own a private practice or small companies, etc. So I wanted to give a little bit of information about some of the accounts offered to them. So you can do an SEP, a simplified employee pension. It's not really a pension. It's just kind of like a 401k for companies. It's also called a solo or independent 401k. This is interesting because you can choose yourself between a Roth and a traditional. You can pull your money out at 59.5. And it's a unique one because even a sole proprietorship or a small company can have one of these, even if you're the only worker, and you as an employee can put in 19.5 to your account, and your employer, which might be yourself, can put an additional sum of money all the way up to a max of $57,000 a year into an account. So it's really advantageous for people with smaller companies. Whatever you choose to match for yourself, so let's say you have 3 employees and you want to make sure you're putting $40,000 away. If you match yourself 100%, you have to match your other employees 100%. So just know that if you're self-employed, it's super helpful because you can match yourself whatever you want with no benefits. But if there's other people working, just remember that requirement. And then there is a required minimum distribution at 72. The simple IRA is for companies that have less than 100 employees. It's an account where it gives employers a much lower expense to provide a 401k to their employees. You can put in a max of 13,500 into an account, and if you're above 50, you can add in an additional 3,000. This is beneficial because your employees will get a match. With a simple IRA, you have to match each employee either 3% of what they contribute or 2% of their salary or annual earnings, regardless. And all of that vests immediately, which is beneficial to the employee, but may be difficult for some employers. One of the main cost savers between this and a 401k is that there's no non-discrimination testing. So 401k plans are often very expensive for companies, but large companies get tax incentives for it. But it's kind of a way where smaller companies can still provide and recruit top talent. Then you have a simple 401k. It's again less than 100 employees. It works very similarly to the IRA. The only really difference is that the kind of what qualifies people to, get access to the funds or get access to put money in is slightly different. So the simple 401k has to be offered to anyone older than 21 years old and at the company for more than 1 year with earnings above 5,000 in that year and the previous year. With the simple IRA, it's anyone who earns more than $5,000 at your company in the past 2 years and is currently expected to make that. So it kind of adds another layer. Let's say a lot of people, or you have a lot of attrition at your company where people only work for a year. It's, the simple 401k kind of forces people to stay at least a year to even put money into this. And then you have the small business 401ks, which is, beneficial because it allows multiple employers to come together and create a 401k plan. So it can either be totally different companies that are in the same region. So let's say it's a tropical smoothie and a dentist office, for example. Or let's say it's two companies across the US, but in the same industry. So, two different dentist office across the US could come together. There's one constraint on that makes it a little bit difficult, is that there's currently a rule that's called one bad apple. So if one company in that group or cohort makes a mistake, then everyone is penalized. However, when I was reading, they are trying to kind of repeal that. And that just needs to be a defined contribution plan. So like a 401k, either traditional or Roth, and there's a few other examples of those. Any questions before I move on to the next one? Cool. And then these are basic accounts for families. So I know a lot of people have kids or they're married in here. So these are interesting accounts that can help you. So there's spousal IRAs. These are really interesting because only one spouse needs to be earning income. So whether a spouse earns a low income or no income at all, the other spouse can still contribute the max amount for both spouses, which really gives, single working families the same advantage as multi-working families, at least for the retirement aspects. You can use a Roth or traditional IRA. And one thing is you have to file a joint tax return. Also, the thing to note is that you can share distributions in retirement. Another really good one is 529 savings plans. So this is for K through 12 and then post-secondary, so college education. This is a really, really interesting one. I know a lot of people in this group went to a Catholic school. In 2017, it was just opened up to allow people to send their kids to private schools. It used to be just set up for colleges, but they've opened it up. So this is something really interesting where you can get some tax benefits for sending your kids to private schools and or saving for college. So one thing that's interesting is your money is kind of not taxed when you put it in, if you put it into your bank account, but if you're earning income, it will be taxed like a traditional IRA. But 30 states allow for deductions. I'm not sure, I couldn't find if Michigan allows for a deduction, and I know there's people in a few different states, so you have to look that up. It's tax deferred. And then if the money is used for qualified expenses like tuition, fees, room and board, technology, it comes out tax-free. And you can put a max of $235,000 per beneficiary. In Michigan, it actually goes up to $500,000. So also, if you're super wealthy, it could be a tax vehicle to just shed wealth. There's also the 529 prepaid tuition plan, which only works for college and secondary education. It lets you basically lock in the cost of college now and pay for it. And then you get it, free or paid for in the future. So one girl I went to school with at Michigan State, her parents, I think, paid $6,000 for her school because they locked it in 95 when she was born. But nowadays, I don't know the benefits as, there's inflated tuition prices. So you can, review that more on your own. Then you have the UGMA and UTMA accounts. So these are accounts that are held by a custodian until the beneficiary hits the legal age. So it's often used for children or grandchildren. The legal age is either 18 or 25, depending on the account. It lets people pass wealth more than just cash. It allows the passing of real estate, of paintings, of artwork, various other assets, and it shelters the beneficiary from the tax burden until they turn 18 or 25. Once they do turn that age, though, they will, have taxes if it's in a financial account. If it's physical assets, it often just goes against their lifetime gift, which is currently 11.58 million per individual or per estate, if someone dies. So there's kind of two taxes that this works for. Often it's for people trying to reduce their estate taxes, but it also has some benefits for passing if you're trying to pass wealth, even if it's just income taxes, although this doesn't have the best income tax shields. This is a pretty complicated account, both of these, so I'd recommend working with a professional on either of these accounts. Any
Huey,
questions?
I've got a question for you.
Yeah, what's up?
For the 529 prepaid tuition, we've been looking into that with the births of some new kids here.
Mhm.
Did you find anything in your research that said what would happen if tuition rates went down? Because obviously you're locking in now. I couldn't find any small print that said we're going to give you that savings. Like, we'll lock you in at this is as high as it could go because we locked you in. But if it went down, I could still have savings. I obviously think they're inflated right now as well. And I wouldn't want to lock in at a high rate.
I did not find anything. I did a bit of research on these, and I couldn't find anything on that because I was interested in that as well. And I also couldn't find if it's, I do know it's select institutions. So if you lock it in, let's say at Michigan State or a cohort of colleges, and your child goes somewhere else, it might not be able to be passed. And that's just a thought.
Yeah.
Ryan,
Anybody else in the group did they start anything? Nobody else with 529s.
I have a question though, Huey. So what happens in Ross? So what happens if your kid doesn't end up going to that school? Do you get that money back, or is it just?
You can pass it to another individual. So whether it's a grandchild or a different child, but you can't pull it out. If you do pull it out, it's a 10% penalty and you pay taxes on it.
Okay.
I think a lot of states have like reciprocity between them too. Like, although it might be like a Michigan plan, they have reciprocity with like a handful of other states, mostly the ones, nearby.
I definitely saw that with the savings plan. I think that was John who was talking. I definitely saw
Yeah, that's the one that we have is the 529 savings plan. I did not look into the prepaid tuition plan.
The 529 savings plans, I will say, are great questions on the prepaid tuition plans. I don't know the answer to a lot of those. Those are not very common at all anymore. I think they went through a stage where they were, but I will say the vast majority of college savings plans that we say are just those 529 accounts, MESP accounts as they're known in Michigan. Those, I think, because of their flexibility, your ability to contribute larger amounts, those are the ones that I think the vast majority of people turn to these days. Yeah, far more common.
Okay, wow, good information. Any more other questions for Huey on all of these different accounts while we're on it? If not, we will be posting, or we'll make these slides available so you can always go back to them and reference them along with all the videos, all the meetings we have.
I guess
Hey, Anna, real quick, one that I don't think we talked about that maybe like Ryan can like maybe elaborate on the benefits of is just like the HSA plans.
Okay, yeah, Ryan, do you have anything off the top of your head now?
Sure, yeah, because those won't, I don't think will really fit in directly to what I'll be talking about. But yeah, HSAs are getting very popular and for good reason. They're great savings vehicles. For anybody who's not familiar, basically an HSA or health savings account is just a piece of a health insurance plan when you have a high deductible plan, like a low cost health insurance plan. It allows you to contribute, I should know the amount, it's 2,000, maybe around 5,000 a year into a tax deferred vehicle. It's similar to an IRA where you get a tax deduction on the way in. So it's taken out of your taxable income the year that you contribute to it. It grows tax free. And the real benefit of an HSA is that as long as it's used for qualified health expenses, you can also pull it out tax free as well. So it's almost like these accounts, even 529 savings plans are the same way. They almost have the best of both worlds. You get the benefits of a traditional IRA and a Roth type vehicle in the same product. The real draw as well to an HSA, even if you are young and healthy and you know that you won't use the funds for a long time, obviously with compounding that can grow a lot over time. And I believe I'd have to do some digging on the exact rules for taking it out at retirement, but I know that at a certain age, those can even be used for like transferring wealth to future generations and stuff like that. Once you hit, a more advanced retirement age, they can even be used for expenses that are outside of like qualified healthcare expenses, stuff like that. So
We'll actually
that answers the question. Let me know if you, have any other specific questions on it, but HSAs are very beneficial.
We'll actually be going through those next week as well.
Oh,
Or
yeah.
next month, more in detail. So we purposely didn't include it into here. But we'll definitely get more into that and make sure we're all squared away.
I have an additional question. For the spousal IRAs, can you do that in addition to like the Roth IRAs, like that you do on an individual basis?
Yep.
Okay.
So you can contribute, or your spouse can contribute, and then you can, or whoever is earning income can transfer and basically deposit into a spousal IRA.
Gotcha.
Okay, any more questions before we move on? Alrighty, well, we are going to move on to our guest speaker, which has already made an appearance, popular guy, Ryan Erdman here, financial advisor for Plant Moran. Poor guy lived with Huey at Michigan State. Sure he saw some of Brandon too, who is not here. He has a bachelor's in finance, went to the College of Business at Michigan State, and he's a CFP candidate, and he's currently studying for that as he'll take it in March. So with that, Ryan, you can kick it off.
Sure thing. Thanks for the introduction. Appreciate you guys letting me join here. I'm excited to be here. I know, as Hugh said as well, I'll try to stop quite often and ask if there's any questions or anything like that. But as I'm going through anything, feel free to jump in and interrupt and ask questions. These are always more fun, more interesting, and more beneficial when they're led by questions. But I've got an overall structure that I can start going through as well. So feel free to jump in. I will start out before I get into one of my main topics, talking just a little bit about asset allocation. It's worth noting that a lot of what my day-to-day in the investment world is based around, and a lot of what these slides will be based around, is investing for the long term. So think of this more as retirement savings, building kind of a stable long-term portfolio that will support you for a long time, that you won't be touching the money for a little while. We don't do a lot of like individual company research or market timing or stock picking or anything like that. So while that's a lot of times more fun and more interesting, that is not exactly my forte. So I know some other guys on this call that would be able to help more with that. But when it comes to putting together an investment portfolio for the long term, asset allocation is one of the most important pieces that determines your actual success of the portfolio and your level of return. And basically what that means is just the split between your equities or your stocks and your fixed income or your bond portion of the portfolio, also known as the overall level of risk in your portfolio. So when you have a broad, well-diversified portfolio, that split between stocks and bonds determines far more of your, long-run returns than maybe the underlying companies that those funds actually hold, which is pretty important. And when you're going through the process of determining your asset allocation, there's three main pieces that you sort of think of. That's your time horizon. Obviously, the longer that you have before you'll need the money, or in a lot of cases that we'll be talking about, it'll be the length of time before your retirement, then the more aggressive that you can be with that portfolio. So a lot of people who are just out of college, who are just starting work, they can invest in a 100% equity or an all stock portfolio and can weather the storm, as they call it, and basically set themselves up for those long-term returns. Risk tolerance is another piece of it, and that's basically the amount of risk that you can stomach. Some people, even if they have a long time horizon and they're young, they just don't like seeing drops like we had in March, and they wouldn't be able to stomach losing money like that. And that's very normal and understandable, but and some people, it doesn't bother them at all. So that's sort of the risk tolerance piece. And then obviously your required rate of return, which is that's kind of the third arm of the triangle, if you will. And that piece just has to do with how much risk do I actually need to take to reach these long-term investment goals. And that a lot of times is backed into through like financial planning software and so on and so forth. So I had already sort of hit on the split between fixed income and equity. I know most people on this call, like I said, the portion that you're more interested in is the equity piece of the portfolio. As far as like 10-year forward-looking returns, or the returns that you could potentially expect for each of these vehicles, fixed income is typically around 2.8% or so a year for a bond portfolio, whereas equities between 7 and 7.5. So that'll come into play a little bit as we talk through those two pieces of the portfolio. But you can go to the next slide if you want. Yeah. The next piece, which piggybacks right off of asset allocation, is asset location. So if asset allocation is what you're actually investing in, or what your portfolio is made up of, asset location is essentially where you are investing those different products in. And a lot of people would think, and I even thought for a long time, if you have, say, a taxable account or an individual account like Hugh went through, and you have a Roth account, you may think that, it's important to kind of diversify each of those accounts. But one of the, I guess, most interesting or most important pieces is that as long as your portfolio, if you look at all of your accounts as a whole, are diversified and have the proper allocation across all of your accounts combined, then there's no reason to diversify each individual account. And in fact, it can be very advantageous to shelter or hold different investment vehicles, I guess you could say, within those specific types of accounts. So we sort of went through on the first slide the tax treatment of these various account types, but just to sort of rehash what Hugh was talking about, essentially across all those accounts, you have three main tax treatments. You have tax deferred, taxable, and tax free. Tax deferred would be any sort of IRA, traditional IRA or traditional 401k, which, as Hugh mentioned, you are not taxed, as he said, on the way in. That basically means that you get a deduction from your taxable income for the amount that you contribute to that account for that year. It grows tax-free, which means that you won't be getting a 1099, you won't be getting a tax statement for the income and dividend, or the interest and dividends that the investments that you're holding in that account kick off throughout the year. And then you will be taxed at your ordinary income rate for the entire dollar amount that you withdraw once you're past that age of 59 and a half and you start pulling that money out in retirement. A taxable account basically doesn't have any tax impact on the way in or the way out. You can think of this as, a Robinhood account or any standard individual account that you open. There's no real tax benefit for putting the money in. You can take the money out whenever you want. But as that money kicks off any interest or dividends throughout the years, you'll be paying, your qualified capital gains tax, your income tax on that income each year. And then any capital gains that you have, so any increase in the principal amount of those investments when you go to sell it, you'll be taxed at, again, those capital gains rates, which are preferential to your ordinary income tax rates. So if you have somebody who is in, say, the highest tax bracket, if they're in the 37% marginal tax bracket, their capital gains would only be taxed at 20%. So there's a pretty big differential there, and there's a pretty big benefit to having, to the capital gains rate that you'd be taxed at versus pulling the money out of a tax deferred account at ordinary income. And that'll make sense in a few minutes when we go through the different types of investments to hold in that account. And then obviously your tax-free account, so your Roth account. There's no tax benefit for putting the money in. You put the money in after tax, so there's no tax deduction when you contribute that, $5,000 or $6,000, or if you're over the age of 50, $7,000 to that account in the year that you put it in. But that money grows tax-free. It's not included in your ordinary income when you pull it out, and it can also, Roths have no minimum distribution rules either. So there'll never be a time where you're forced to take the money out. And that is why Roth IRA accounts are also very useful wealth transfer vehicles as well. So you can pass money on to future generations. So the important reason for going through all of that is you can look at different types of investments and the way that they grow and the way that they kick off in income each year, and shelter them within each of these three types of accounts to be very tax advantageous. So the priorities say for a tax deferred account like a traditional IRA, if you have any fixed income or any bonds in your portfolio, it is hugely beneficial to shelter that fixed income into a tax deferred account in your portfolio, versus if you have, say, in a taxable account, something that will maybe not kick off a lot of income, but will have hopefully true capital gain potential, or it'll just grow over time, such as maybe a large cap US stock fund, like an S&P 500 index fund, something like that, is very beneficial to maybe hold in a taxable account. And the reason for that is, if we go back up to the tax deferred model, if we were to say put an S&P 500 index fund into a tax deferred account, all of that growth that builds up over time, you will end up paying ordinary income tax rates at years down the road, because it's held in that tax deferred account, which you'll be taxed when you withdraw the money. So dollar for dollar, every dollar that you increase the principal of that account, if you will, you'll be taxed at ordinary income rates. Whereas if you hold it in a taxable account, when you eventually sell that investment and withdraw your earnings, you're taxed at capital gain rates. Now, to show kind of the other side of the coin as well, if you were to put a fixed income fund into a taxable account, you're not really getting that long-term capital appreciation growth out of those bonds, but they will be kicking out ordinary income every single year, and you'll be paying tax every single year on that ordinary income as you basically get those 1099s in the mail every February and have to include them on your tax return. Whereas if it's held in a tax deferred vehicle, that money and all that income, the interest and dividends that are kicked off just year by year, if you don't actually sell the investments, you're not paying tax on any of that, because it's sheltered within that tax deferred growth, if that makes sense. I'll stop there. Does anybody have any questions? I guess I know I threw a lot of info at you there in that those first couple slides, but any questions?
I have one. Does it?
Yeah.
Are you going to explain now, like, the impacts of a Roth?
Yep. Yeah. So then, I guess the third type of account, that tax-free account, the Roth, that is a place where you'd most likely want to shelter your highest growth assets that you would have. Maybe if it's, your emerging market international equities or your small cap US bond funds, stuff like that, that aren't necessarily tax efficient, like an S&P 500 index fund that would just provide, stable routine growth each year. But that, with a Roth, once you have that money in that account, that you're never going to pay tax on it again. So that is what you'd kind of want your highest octane growth, or your, highest potential for capital appreciation. Those are the type of assets that you'd likely want to put into a Roth. So there is some overlap between taxable and Roth, obviously. I would say the biggest differential for asset location, like we're talking about here, tax hierarchy, is between tax deferred and taxable holding equities versus fixed income. A lot of times you'll sometimes see people who hold maybe, municipal bonds in a taxable account. Municipal bonds are exempt from federal income tax. So there are times where people will feel like they're, getting a tax benefit out of municipal bonds, but a lot of times the coupon rates there are slightly lower than on taxable bonds. So rather than holding your equities in your IRA and bonds in a taxable account, if you can flip it, like we just talked about a few minutes ago, a lot of times that can lead to some long-term tax benefits by sheltering your ordinary income in a traditional IRA and putting your higher growth assets either in a taxable account or, preferably if you have one, a Roth account. If that hopefully answers your question. Yeah. Any other questions before we move on? All right. So this is a topic that I know I've talked to Hugh about, and he is very interested in and gets excited about. So one of the big considerations for investors, especially when you have, say, a large and very fast drop in the market like we had in March, is do I, essentially choosing between remaining invested, riding out, nobody wants to sell low, obviously. So kind of riding out that stock pick, riding out those investments, and kind of waiting until they come back, because obviously, as we've seen, the market always comes back. It always has, but it, every time always feels a little bit different or feels a little bit darker when it's at the depths. But, or do I sell that investment at a loss and basically book what we call, this is tax loss harvesting, but basically booking that loss when the stock is low. So the benefit to selling low would be if you say bought a stock for $100,000, it goes down to, it now sits at $80,000. If you sell that, you basically book a $20,000 tax loss, which can be used to offset future realized gains. When you eventually then sell other positions for a realized gain, those losses that you booked, well, it stings when it happens and it's not ideal in an investing sense. Obviously, nobody wants to sell low and sell for a loss, but can be used to, offset future gains and essentially improve your overall tax position, if you will. So another important point there is, say we have a year, like this happened a lot in 2018, where at the very end of the year, there were, the market really had like a serious downturn, and through about late November through the end of the year. If you book a large amount of tax losses to where you have a net capital loss for the year, you can even use 3,000 of that to offset ordinary income. So you can offset $3,000 of ordinary income, and then anything above and beyond that 3,000 can be carried over into future tax years indefinitely. So you can then continue to use, if you had $150,000 of tax losses for this one year, you can continue to basically offset your future realized gains for an unlimited number of years into the future, which is a huge benefit. So the point that we're getting to here is there is a way to essentially do both. There is a way to book tax losses and remain invested in the market at the same time. So what you can do, and this again isn't quite as possible if you are picking individual stocks, because it's obviously if you sell an individual stock, you're no longer invested in that individual stock. But I'll use the example of say like index funds or ETFs. If you're doing more kind of low cost diversified investing, if you sell say like the S&P 500 index fund at a low point, and that same day you buy a fund that is similar to it and it maintains that market exposure but is not the exact same fund, you essentially have booked that tax loss but have also remained invested in the market and can still kind of ride the roller coaster back up, if you will, and didn't miss out on any potential upside by selling low, because nothing feels worse, obviously, than if somebody had sold March 23rd of this year and never bought back in and is sitting, after the market bounced back very quickly into the summer, and they weren't able to get any of that, the benefit on the upside. So that is kind of the idea of tax loss harvesting, is you can sell an investment at a loss, purchase something that is very similar but not identical, and still remain invested in that asset class or invested in equities overall. So it's very important to note that there are a lot of asterisks with this process, and it's something that you'll definitely, if you are thinking about doing it, highly recommend talking to your tax professional or whoever you are working with, because if you do buy something that is too similar, or say I had Apple stock, for example, if I sell it one day and I buy it back the next day, if it's within a 30-day period, that's what's called a wash sale. And wash sales will disallow that loss. So basically you won't be able to book that tax loss, and your new basis would just become what you repurchased it at, if you will. So the loss wouldn't necessarily be booked at all, if that makes sense. So a good example of similar but not identical is if I were to let's say the S&P 5, the Vanguard S&P 500 index fund. It's the ticker VFIAX. It basically just tracks the S&P 500, which we had talked about earlier. If I sell that and buy the Fidelity S&P 500 index fund, that's obviously the exact same fund. So that would be considered a wash sale, something that is, there's no material difference between the two funds. They both track the same index, everything like that. But if you were to buy there's a fund called the Vanguard Large Cap Index, or VLCAX, that also tracks a chunk of the largest companies in the US. It still maintains all of your exposure to US equity, so on and so forth, but is considered just materially different enough that you're able to book that tax loss and it's not considered a wash sale. So like I said, there's a lot of intricacies with the funds that you can and can't buy. And that's something that before doing so, you should absolutely check with a tax professional, just to make sure that you won't run yourself into a wash sale, and that you are basically maintaining the same market exposure. But that's kind of the idea behind tax loss harvesting. So
I have a question.
Yeah. Mm-hmm.
This is Hugh. Hugh's dad, the good Hugh. What about married couples? What if I sold my Apple stock, can my wife buy it? Or is
That's a great question. And no, that is also a wash sale. So basically it is for anybody who files a joint tax return is considered the same taxpayer, if that makes sense. So as long as those that, I guess you could say, if that wash sale is going to kind of end up on the same tax return, that is what separates it. So that's a very good question. Because some people even have thought about like, oh, if I sell, again, I'm using the S&P 500 index fund a lot, but if I sell the S&P 500 index fund in my taxable account and I buy it back in my Roth IRA, does that count? And that still is the same thing. That is also a wash sale. So that's a good way to think about it, is as long as it's ending up on the same tax return, it's considered the same person. So.
Another question or observation here. It's Joe speaking.
Mm-hmm.
I missed out on a perfect opportunity getting married in June and there being a market crash in March to loss harvest. Saying that my wife could have bought the Apple stock I sold because we weren't married until June.
Oh, I see. Good question. Okay, so that actually comes back to, what is considered married and what isn't. So, as I believe, there's probably, I'm sure, some people on this call that might be able to confirm if I'm correct on this. But I think as long as you are married by December 31st of that year, then you file a married filing jointly tax return for that entire year, and you are considered married for that entire year. So that's an important thing to remember. Yeah. Because you wouldn't be filing your tax return until, say, if it was June of 2020, you wouldn't be filing your tax return until March or April of 2021, and all of 2020 would be considered married. So you'd wind up on the same tax return. Yeah.
What happens if you file separately? You're married but file separately? Or are the tax implications that doesn't make sense to do that?
That's another good question. And I would have to confirm that, because obviously married filing separate is, one of the more rare filing types, I guess you could say. But I would venture to guess that you would be able to do it then, since the sale and the buy aren't winding up on the same tax return. Then that should, in theory, be allowed. But that's something that you definitely want to confirm. Yeah, but good question.
Ryan, quick question, Blair here.
Yeah.
Kind of on the opposite spectrum as the tax loss harvesting.
Mm-hmm.
You could call it tax gain harvesting, I guess. If you expect to, let's say in a current year, your income is much lower than you anticipate it to be. Let's say it's December 28th and I have large gains from my basis in the S&P index.
Yeah.
Can I sell on the 28th and then purchase, knowing that in the following year my income will be much higher, so I'll be in a larger tax bracket to decrease my basis for that current year? Do I have to wait a certain amount of days to repurchase those funds? Does that make sense?
It does. Yep, that definitely makes sense. And nope, not at all. You don't. Yep. So you could sell. Yeah, you could sell on Thursday. You could buy back on Friday, and there's no disallowment or anything like that. That's perfectly allowed. And the reason for that is that I guess there wouldn't be a huge benefit to that, because especially with long-term holdings, the idea is kind of, this kind of comes back to the whole basis for why IRA accounts were created in the first place, kind of that tax deferral. A lot of times, if you can defer the payment of tax on something, then that's beneficial to you. So if you had, say, huge gains in the S&P 500 index fund, let's just stick with that example, then if you are going to sell it and buy it back the same day, then you really have materially held that fund the entire time. But if you sold it, booked all those gains, and then bought it right back, you would just wind up with a much higher tax bill at the end of that year for something that isn't really getting you a benefit, if that makes sense, because you're still holding on to the fund. The only time, I guess, in theory, that you would want to book a huge tax gain like that is if you maybe had picked an individual stock and it had a huge run, and you just feel like it's going to tank. You have a bad feeling. You feel like it's at the top of the market. Then you could, in theory, do that, and that would be. And you obviously wouldn't buy it back, because then you feel like you're kind of at the top of the market, and you're just kind of cashing in your winnings and running the other way. But yeah, if the goal is to remain invested, then in theory, you'd want to kind of defer those gains as far into the future as you want, and not book them when they're high like that. If hopefully that answers the question.
Yeah, thank you.
Okay, sure.
Can I ask a similar kind of the same question as Blair? Because now I'm curious.
Yeah.
So in some people's cases, they own their own company. So let's say like York. If I know I'm going to pay myself, let's just use a low number, $15,000 in 1 year, and I book a gain because I know I'm going to be low, and then next year I know I'm going to pay myself $70,000. Is there a benefit to doing what Blair just described?
Is this still going back to like when you say booking a gain in the low year?
Yeah.
um,
Selling it and then buying it back.
Selling it and then buying it back. Again, there's really no tax benefit to ever booking a gain. Like I said, if you're going to remain invested in that, then there's really no benefit to selling it and paying taxable income on something that you could have just continued to hold and not paid the income on. Does that kind of make sense? So this actually, this is a perfect lead into to the next slide actually, but in a year when you would be, say when your income is lower than usual, actually a lot of people this year that happens, whether if you're a small business owner or something like that, if your income is significantly lower one year rather than the next, a good way to kind of max out your current tax bracket, or if you're looking to bump up your income in that year, would be to complete a Roth conversion. So basically Roth conversions, I guess, as we all know, you can contribute to a Roth account, like Hugh had said, and there's no, if you just are contributing from, a bank account or a taxable account to a Roth IRA, there's no deduction to taxable income that happens when you put that money in, but then that money is completely tax-free. Now, the difficulty comes in for high income earners because I can't remember off the top of my head, it's just over 200,000, between 200 and 230,000 is when you are capped out and you are no longer able to contribute to a Roth IRA. Since Roth IRAs are considered vehicles for people who maybe don't have a ton of taxable income right now, but they know that their taxable income, will be a lot higher in the future, which in most cases that, lends itself toward young people who know that, traditionally your income will increase throughout the length of your career. So you're capped out. High income earners basically can't contribute to Roth accounts. However, the IRS has basically given I guess you can call it a loophole, but it's a very well-known one, that any IRA dollars whatsoever in a traditional IRA in any amount can be contributed to a Roth account at any time. There's no cap on it. So even if you had a massive amount of money in a traditional IRA, you could convert that entire IRA account or any portion of the IRA account to Roth in any given year. And that's completely allowed. Now, obviously the drawback of that, or the decision point of it, is that all of that money will be included in your taxable income that year. So say you have a $100,000 traditional IRA, you decide to convert the entire balance of that to a Roth IRA, your taxable income for that year will have $100,000 added onto it, and you'll be paying ordinary income tax on that $100,000. But then that money is in the Roth account, and it's you will never pay tax on it again, essentially. So people do this for various reasons. A lot of times it's even in, say at the end of the year like this, where with the current political climate and with the election coming up, a possible change of administration, income, there's a high chance that income tax rates would go up in the future. Then a lot of times what people will do, again, like Hugh was mentioning, if you think that tax rates will be higher in the future than they are now, regardless of whether that's because you're earning more income or because tax rates in general will just be higher, it can be a good idea to basically convert dollars to Roth now, pay tax on it now when you're at when you're either in a lower bracket or when marginal rates are lower overall, and then that'll provide a benefit in later years when the tax rates are potentially higher. If that makes sense. I'll pause there if there's any questions on that.
Hey, Ryan, are you still limited to the, I don't know what it is, the $6,000 maximum contribution to the traditional IRA each year? Because like in your example, you said 100,000. You're assuming
Yep.
that someone would have contributed for many, many years, built up the balance to 100,000, and then convert it.
Exactly.
Versus like a contributing 50,000 2 years in a row.
Exactly. Yep. Yeah. So the 6,000 still is in place for Roth and traditional IRAs. that never changes. That's always across the board. So yeah, when I use the example, say, of somebody who has, you know, $100,000 or something in a traditional IRA, that would have been built up over time. Maybe it's a rollover from a 401k, or somebody who had contributed many years, and there was also, you know, investment growth in there as well. Yep. So there still is the cap on traditional IRA contributions.
Okay, but like, so if you have an employer sponsored 401k plan with the maximum contributions of, you know, whatever, the 19,000 a year, you could convert your 401k into a traditional IRA and then backdoor that. Or how would that process
Yes,
work?
exactly. So the thing that you'd have to check on with that is a lot of 401k plans don't allow you to roll to an outside IRA until you retire. There are certain 401k plans that allow you to move a portion of your 401k to an IRA. That's called like an in-service distribution or an in-service withdrawal. That's typically for people who are a little bit older and still working. I think some plan, it's very plan specific. So it's something that you just have to check with your company's specific 401k. But a lot of times, yeah, if you're maybe over 50 years old and have worked there for 10 or more years, then they'll allow those in-service withdrawals. And those are about the only time that you'd be able to roll your 401k account or a portion of your 401k account to a traditional IRA. And then once it's in a traditional IRA, you can definitely, convert to a Roth at any time then. And the same goes for, say, if you retire, or if you maybe leave your job, if you move companies, that old 401k, that can very easily be then rolled right into a traditional IRA and then converted to Roth as well. So.
Then last question. So if you're contributing money into the traditional IRA, is there a set time limit that the IRS requires it to sit there before you convert it? Or I read various sources on this, but on Fidelity, it seems like you can just do it after, like, contribute to a traditional, and then the next button, click convert to Roth. Like, it doesn't seem like it makes you slow down the process at all.
Right. Yep. No, you found like a massive gray area there, and something that people like don't always agree upon. The short answer is no. There's no time limit. You could contribute to, you could have contributed to a traditional IRA today, and tomorrow morning you can convert it to Roth, and that, there's no detriment to that. Certain people will tell you that it's safer to wait a certain amount of time. If the IRS ever comes back with rules that there could be clawback or something like that, there's some people that like to wait maybe 60 days or 90 days just to be extra sure. But bottom line is, as it stands today, there's no specific rule that says that you have to wait any amount of time. But a lot of people will wait, maybe a month, 2 months, 3 months, just to be extra safe. But
I have another question. So if, I guess maybe for the younger crowd, if you think in the future that you'll be in a higher tax basis, it might be, would you say it's more beneficial than kind of leaving your traditional open so you never get hit with, a massive tax bill? Like you described, 100,000, but if you don't contribute to it, it'll be lower, in that year that you convert it, it'll be a much lower tax bill in that year.
I see. So are you saying, like, for somebody who's young and has money in a traditional IRA right now, whether it's beneficial to convert it to Roth or not?
Yeah, and or just like purposely leave their traditional open. So if they ever want to convert it in the future, if they ever make over $200,000, then they can convert it without a massive 1-year tax bill.
Yeah, when you say leave it open, do you mean leave it open and empty, or leave money in it?
Open and empty.
Open and empty. Yeah. So it's a great point. I'll kind of, answer both of those. So I would definitely agree that for most young people, if you do have money in a traditional IRA, that it would likely, it's obviously very individual and it depends on your situation, but I would say that likely makes sense if you expect that your income will be higher later in your career, which most of the time traditionally it is, then it would make sense to convert that money to Roth now. You'll either pay tax on it now and get it over with, or it'll just continue to grow and grow and grow, and then you'll be paying tax on the entire balance rather than just what you've contributed right now. And you'll also likely be at a higher income tax rate in the future as well. So that is very beneficial. And Roth money in general, whether it's a Roth 401k or a Roth IRA or anything like that, has serious benefits for especially for young people, but honestly for everyone as well. And as far as leaving your traditional IRA open, so say you converted your entire traditional IRA to Roth, you can leave it open if you want to. It depends on the conversion too, depending on what custodian you have, whether it's Vanguard, whether it's Fidelity, whether it's Schwab, so on and so forth. Some of them the account will close automatically. Some of them will keep the account open. Bottom line is that it doesn't really matter, because if, say, 30 years down the road, you decide that you want to contribute to a traditional IRA again, maybe as part of a backdoor strategy, which I can go over in a second, then you can easily just open another IRA account at that time. There's no limit to the number of IRA accounts that you can have open at one time. The only limit is the amount of money that you can contribute to it per year, if that makes sense. So if I wanted to open, 11 different IRA accounts and contribute $300 to each of them, that would still be, I think, as long as I did my quick math right, that should be perfectly fine. It just wouldn't necessarily make sense. But yeah, you can open and have as many IRA accounts as you want, and anybody can open an IRA account as well. But it just it depends on whether you're able to contribute to it. So
I have a question.
Mhm.
So I'm older, so it's beyond me, but for the young people on this, can they open, is there a age limit for the Roth? So for example, Blair, Herzler, people with young kids, could they open a Roth and contribute the max? And like as a vehicle to grow funds for their children?
That's a great point. And it depends on, so do you mean if, is the Roth in the child's name, or is it something that is in your name that you would eventually be, like, say, gifting to them?
It's in the child's name. So I've heard that, like,
Yeah.
some, like, say doctors will say,
Mhm.
well, my child is a model, like literally like Gerber baby model.
Right.
So they have an income, so you have to pay income tax, but they're putting the amount in that their child technically earns, which they really don't, but
Mhm.
I mean, it's around the tax system, but nevertheless, it's growing money,
Sure.
today's dollars versus, that. So is that something like a young professional should look into when they're like Camille, Ross, John?
Right.
Rick, yeah.
And the answer is definitely, but the distinction just comes down to that earned income that you were talking about. So any individual, any human being, regardless, can open and fund a Roth IRA account as long as they have earned income, and it can only be up to the amount of earned income that they have. So that's kind of funny, like you said, if there's money that the child technically earned, as long as they have a W-2 with their name on it and they file a tax return for that earned income, then that's considered earned income, and they can contribute that amount to their to that Roth IRA that year. And that would absolutely be a beneficial strategy, as early as you can, as early as possible, basically, when kids start having earned income and start, filing their own tax return and so on and so forth. The earlier that you can get money into a Roth and invested, the better off that you'll be, because the, power of compounding over that many decades is amazing. So yes, that would definitely be a beneficial strategy, but it just comes down to what is actually considered earned income, because an example that a lot of times we'll use is if your 8-year-old son shovels the snow on the neighbor's driveway, or does the entire neighborhood, and throughout the winter earns, a few $100 or $1,000, that isn't necessarily considered earned income, rather, from a legal sense. So they, in that case, would probably not be able to contribute to a Roth IRA in that case, if that distinction kind of makes sense. Yeah.
So it matters whether they're paying payroll taxes.
Yes, exactly. Yep. So
As
it
long
has
as
to
they're paying
be,
payroll taxes, I mean, they can shelter the money and let it grow for their kids, and feasibly, I mean, the sky's the limit if you have enough money to do that when you're young.
exactly. Mhm.
Yeah,
Yeah.
and I don't mean to interrupt or jump in, but Aunt Ruth,
Yeah.
one of the CPA consultant firms, one of the biggest ones in the ortho industry, strongly recommends by the time your kid's 5 or 6, which is, pretty early, most people would say, to go ahead and put them on payroll. If you have them on your website with marketing, if you have them come in, shred some papers, and then of course up to, I think, what is it, Ryan, $12,000 of their earned income is tax free. Only 6,000 is eligible for a Roth, but 100% I've read that numerous times over the last couple of years.
So
Yeah. Couldn't agree more. Yep. Absolutely.
How could a person like myself or Camille or Ross, who works for a firm or corporation, take advantage of that without owning a business?
That's a good question. Yeah, that I don't know. That's not something that I've really thought about in the past. Do you mean how could you get your child in a position to have earned income, basically? Is that
Yeah, like they would have to be like a model, like the Gerber model example is pretty much the only route you can go.
Right. I would think so. I'm not sure if anybody else on the call has some more experience or has heard of any creative ideas with that, but yeah, I'm not sure.
I mean, they have to be employed by some firm, whether that's your side gig firm or that's, White Orthodontics or Plant Moran. They have to have that.
Well, Blair, let me know if you guys are hiring soon.
Yeah, Colette's really good at acting. She loves smoothies. She can shred papers, I'm sure.
I'll be honest with you. I added Blake to our QuickBooks account to start paying him in April, and then COVID hit. I was like, better wait. But I really want to.
He already got laid off.
Yeah.
Is he part of your full-time employee count?
Maybe he got unemployment too, right?
Right.
He hasn't come back to work yet. He's still collecting his $600 a week.
There's no rules about how old the kid must be. I thought like 16 was the age you could work and be. Is that not a law?
So I know a lot of that's a good point. That might be a gray area as well that you'd want to look into, because I think a lot of companies have restrictions to like when they would start hiring employees, but I don't know what the actual. Yeah, I don't know I don't think that necessarily plays into this as much, like whether they're able to, as long as it's considered earned income, that's all the IRS cares about from a contribution standpoint. But as far as what the, restrictions of the company are that would bring your child, that would probably be more of the question mark there that I would have, that I would want to confirm. Yeah.
What I've read is there's certainly some gray area, but as long as you can justify, what's being earned, then and document it, then it works.
So I think
Maybe I have to LLC.
What's that?
Maybe I'll LLC and put her on my own payroll.
Yeah.
Right. Really. I mean,
yeah. The
young
IRS is just kind of.
It's not hard.
Yeah. Mm-hmm. Yeah. The IRS is just kind of like a pseudo court of law. It's just as long as you can prove it and you can point to the proof, then that's all that really what it comes down to. But
well, I guess to my initial question, there's no age in terms of the Roth. There's no age maximum.
In terms of age maximum or minimum?
I guess minimum.
Okay, so yeah, I don't know why I clarified, because there's not really a maximum either. But correct, there's no, as when it comes to IRAs and Roth IRAs, there is no age restriction. There's just an earned income restriction. So obviously the two typically go hand in hand. It's, you're 16 or 18 or so usually before you have earned income, and except for these situations that we're talking about. But correct, yeah, no age restriction, just an earned income restriction. And it's important to note too that, the difference between earned income and unearned income. So just because the income winds up on a child's tax return doesn't necessarily mean it's earned income either. It has to be true like wage, W-2 income. So say a child has a large trust account or investment account that is for some reason taxed back to them, and they have, $15,000 of, investment income, like interest and dividends from an investment account. That could not be contributed to a Roth or a traditional IRA because that's considered unearned income or passive income. It's not considered earned income or wages. So that's just kind of another important layer to it to consider, because I know people, I think, have tried to do that as well in the past.
And one last question for the young people out there.
Yeah.
So I was told, do the balance, like how much you're going to pay in payroll taxes versus how much they're going to get the benefit of a Roth. So how do people know what that balance is? Like, how do you go on and figure, okay, I'm going to pay, say, $10,000 in payroll taxes, but my kid's going to get, this much. And so how does a person know how to do that balance?
Yeah, that's a really good question. One that I don't know the answer to. That's definitely something that you'd want to check with, any CPA or your CPA who would be preparing that tax return. They would probably be able to give a much more accurate or apples to apples figure of what the benefit would be. Like you said, the benefit of paying all those payroll taxes versus the benefit that you'll get for actually contributing the wages that they earn to that account. But yeah, that's something that I am not sure. And I think it would probably be really specific situation to situation, depending on the business. Not sure if anybody has anything to add there.
Thank you.
Yeah.
I got one more question on just the different accounts we talked about previously. So
yeah,
let's just say I have an employer 401k, and because I'm sure this will relate to people down the road maybe, and then you switch employers, find a new job after 5 or 6 years. So you got a good chunk of balance in that account.
Mm-hmm.
Your options are roll that into your new employer's 401k program,
mm-hmm.
or what sounds like put it in a traditional IRA.
Yep.
Instead of letting it sit in that traditional IRA, if you went that route, is it like always more advantageous to just, if you're in that situation, convert it to a Roth? Or really you're only betting, if you leave it in the traditional, you're just betting that your tax rates are going to go down long term from where they are today?
Right. That's a really good question. Yeah. So there's kind of two important pieces there. Like you said, if you leave a job and you have a 401k balance at the old job, there's kind of, as you mentioned, you have three options. You can leave it in that 401k. It's not going anywhere. You can leave it in there and it'll be fine. It'll keep growing. You can transfer it to your new company's 401k plan. That's almost always allowed. I'm sure there's some, asterisks there, or certain restrictions for some smaller companies, but you can roll it to your new company's 401k, or you can roll it to an IRA. And most of the time, people will want to either roll it to their new 401k just to keep things consolidated, or roll it to an outside IRA. There's not too many people that'll leave it in the old 401k just because people a lot of times don't want, money just sitting in these old, various accounts. And as far as moving it to your new 401k or moving it to a traditional IRA, a lot of decision factors there. A traditional IRA has a little more flexibility. You can invest in anything you want, any stocks, any bonds, any ETFs, any mutual funds. It's very flexible and very low cost. There's no, you're not paying in any annual expenses or anything like that. Whereas if you move it to your new company's 401k, the benefit is that maybe everything's consolidated. You can look at all of your full retirement account in one spot. But the downside would be that you have maybe more limited investment options. You just have to choose from your company's 401k options that they have available, which in some cases, some companies have awesome 401ks with great investment options, and others might not have very great choices at all. So kind of just some individual points to think about there. But as far as the second part of your question was,
like in that situation, like it seems like in that situation, it's probably better off to keep it in a traditional versus rolling it into the new employer based on the investment flexibility and the ability to diversify and lower cost funds. For example, like you said, like a lot of the funds that your employer might offer could be charging 0.5%. And maybe there is an index fund, but it's probably not as low of a percent as like, like the Vanguard total market or something like that.
Exactly. Yep.
Okay, that's helpful.
Yep.
And then, so yeah, the second part was just like, as opposed to just leaving it there then in a traditional, would you like almost always say convert that to a Roth if you have that, if you're kind of given that opportunity to move all of it out of your employer 401k into that account, you're like halfway there to be able to convert it. So is that like the normal course, or is it just dependent on what you think tax rates are going to do?
Right. That one, that's where there are a lot more question marks that'll come in, and that really depends on your individual situation. So it depends on a lot of things. It depends on your age. Obviously, the younger you are, the more it may make sense to convert that to Roth as soon as you can, because your income is likely, some of the lowest that it'll ever be, so on and so forth. You have to consider what your income is that year, because it also can be beneficial you can convert to Roth over multiple years. If you just want to maybe convert like 5,000 a year or something like that, do it in smaller chunks. You can also do that so that you're not smacked with this giant tax bill at the end of 1 year for converting your entire old 401k to Roth. That probably, I would say, wouldn't be recommended, just because that tax bill is going to hurt in April. But you have to kind of consider your own income situation. If you have a year that your income is a lot lower than usual, that might be really beneficial. But if your income is, if you just had a killer year and you are making the most you ever have, then it probably doesn't make sense to tack on a ton of extra taxable income on top of that. And I would say, the third question mark or consideration there is what tax rates are going to do in the future. So in a year like this, if you are dead set and confident that tax rates are going to go up a ton in the next few years, then maybe it would make more sense to take advantage of the lower rates and convert more to Roth now, rather than waiting into the future. But I would say, Roth conversions definitely have a place. They can be really beneficial, but it's something that is just very individual, a very case by case basis, and something that you definitely want to kind of consider all of those factors before deciding, whether or not to convert to Roth. But those are kind of the points that you can have in the back of your mind as you're thinking about it.
Thanks.
Yeah. That pretty much covers most of what I was going to go through. The backdoor strategy, I can give a quick overview on that. Backdoor strategy is something that is used, backdoor Roth conversions, for typically very high net worth individuals and families who are maxed out they can't contribute to Roth anymore. And maybe if they don't have IRA dollars already that they can be converting, what you can do is you can make non-deductible IRA contributions. There's also an income phase out, which is lower. It's about 105 to 115-ish or so of taxable income, where your contributions to a traditional IRA are no longer deductible. So you're basically not getting the tax deduction benefit as when you put the money in. So typically the only time that non-deductible IRA contributions would be used is as part of a backdoor strategy like we're talking about here. So what you can do is if you're completely capped out above the 200 and something threshold of the Roth phase out, then you can make non-deductible contributions to a traditional IRA. and then wait the, either 0 or 30 or 60 or 90 days, like we were talking about earlier. You can wait that specified amount of time and convert to Roth that way. So basically, when you hear people talking about backdoor Roth conversions, it's essentially just a way for very high income earners who aren't able to contribute to a Roth IRA to basically get money into a Roth IRA in that fashion year by year, which, may not seem like a lot if you're just contributing, those max contributions for somebody who maybe earns a lot of income. But if you're able to do, if they're over 50 years old and you can contribute $7,000 for husband, $7,000 for wife, that $14,000 can really still make a difference if you're doing it year after year. That can really add up and get a lot of money socked away into a Roth account, whether it's for them or for future generations. So that's, kind of the quick overview of backdoors.
Okay, well, thank you, Ryan, for all that wealth of knowledge. If people have to go, I know it's getting late. You're free to go. You could go a long time ago, but if you want to stick around and ask Ryan questions or anyone else, we'll be here. So if you want to go ahead, but if not, Ryan, I'm sure you'll get hit with some more questions, so we'll stick around.
Yep. Yeah. Thanks for coming out, guys. Whoever is going to be taking off. But yeah, like Anna said, I can stick around and I'm happy to talk through some more stuff and answer any more questions that people may have if they want to stick around. But thanks for listening.
Hey, Ryan, quick question. This goes into harvesting losses.
Yeah.
So let's say that we'll use your S&P 500 example. Let's say that I bought it at 1,000, or I bought it at $100, and then I went to sell at 50 to harvest the losses, then decided I want it and bought it back immediately. Would that be my new cost basis? So now if it goes back up to 100 and I sell at 100, am I paying a capital gains tax on that bump from 50 to 100?
That's a great
question. Or
question.
do I get my original cost basis of what I originally purchased at?
Basically what it is the loss that the simple answer is that it's your original cost basis. Yeah. When there's a wash sale disallowment, as they call it, basically what it is that loss that you would have theoretically booked before you bought it back is then just added back to your new cost basis. So it's as if you had never sold it. So you still have your original cost basis. So using that example, if you bought it at 100, sold it at 50, you bought it back at 3 days later at 50, it goes up to 200 and you sell it, you would only be charged for $100 of capital gain. So it's basically your basis. That loss is just added back to your basis. So yeah, that's a good point. I should have mentioned that. Yeah, thanks for bringing that up.
Okay, this is Teresa. I have a question about the health savings. So I don't know if you want me to wait till next week, but I couldn't figure out how to ask before.
Okay.
Our out-of-pocket expenses for medical is like $5,400. So my husband doesn't want to use our money now because we're over 50. So, but we've had qualified expenses for like the last 10 years. So does that mean I can take out $54,000 tax-free as long as I have qualified expenses?
Ooh, that's a good question. That I don't know. And somebody else might.
I think you can.
I'm not sure if it has to be paid directly or as long as you have, is it just as long as you have like documentation that you pay to reimburse yourself?
Yes.
Awesome.
So like there's no time limit on how far you can go back. Say for the next 10 years, we don't take any. So that means in 20 years, I can take out 108,000 tax-free. Is there a limit on that?
That's my understanding, yeah.
As long as
You
you
can do it.
provide receipts, yes,
Yeah.
you can do that.
Okay.
So that money you hadn't been paying can earn interest. It's genius.
Yeah.
Right. The
That's
difference though is that you have to be in the HSA when you got injured. So let's say you just started your HSA now, you can't go back 10 years. But I know
Correct.
like, when I had my pneumonia, I let it grow for a bit and then I went back and I pulled it out later. So I know
Right.
for sure you
Okay.
can do that.
Yeah.
So
That's very
Anna and females and people with kids consider that, because a lot of people tell you, and we can talk about it more next week. A lot of people tell you like, oh, you're having a kid, switch to low deductible. But then you lose the HSA. And if you have all these medical expenses when you're on this low deductible plan, yeah, it might save you a little bit more money now, but you won't be able to contribute to the HSA. And then also it sounds like later down the road, if you do switch back to HSA, you can't use any of those expensive, hospital years from pregnancies to get that money back.
Okay.
And I know with HSAs, we can talk about it more next week, but their deductibles aren't significantly higher than, a PPO or a low deductible. So, but we can get into more of that next week. So
Love me an HSA.
I'm super interested to tune in for that. I will be here again. I want to learn more about that. Yeah.
I can, Anna, I can provide you guys with a really nifty little calculator for how, when you're trying to figure out if you should sign up for a high deductible health plan versus it has you input things like what your annual health expenses are. Obviously no one's really going to know that, but you have an idea. And then also what kind of premiums you want to pay. It's really quite nice. I used it to when we signed up for our health insurance. So that might be a good resource for some people who are trying to figure out what they want to do, because health insurance sucks.
Yeah, I think that'd be good now, Blair, especially because this time of the year, people are signing up for plans and everything. So it'd be nice to have that information.
Yeah, I'll get that.
Yeah, if you want to just email it to me and I can distribute it to everyone else, that'd be great. Thanks.
All right, peace out, y'all. Thanks so much.
Wait, I have a question for Ross.
Yeah.
Oh, see you, Blair.
What beach are you on, Ross?
Yeah, that's.
What am I on?
What beach are you on?
Oh
I
gosh.
know
No,
it's not Rose Lake. So.
no, this one was done as a joke a long time ago, and then we stopped using Zoom. We use Teams for all of our calls now. So this is a relic of, I don't even know what. I pulled it up for a joke.
There is a Spartan Stadium one,
I will have to use it. Next meeting, you might see me somewhere else. Where's Waldo? Carmen San Diego.
All right, I'm taking off too. See you guys.
Yep.
Thanks, everybody.
Yeah. Thanks, Ryan.
Thanks, Ryan.
Bye.
Way to go. Way to
We're
represent
gonna-
Plant Moran, buddy.
You're gonna record it
Yeah.
too, so we'll put it up on YouTube for the group.
He meant to say caveat, this is not financial advice. Legally, you cannot bind me.
100% Thought about doing an entire disclaimer at the beginning saying nothing I am about to say constitutes an investment recommendation or advice on behalf of Plant Moran Financial Advisors, PLLP.
Sue Plant and put 3 of you guys out of a job.
I signed something. Who sent me? Why did I give my information? I signed something.
we're still recording, so it's documented. You're good.
Exactly. It's on there, so we've got it. Yep.
Thank you guys for putting this together. Anna, Hugh, whoever else is involved in putting it all together. Very professional.
Guys, yeah, this is awesome. So thanks to you guys too for coming out and listening to me ramble for all that time. So hopefully you got something out of it.
Wrapped audience.
Mhm.
All right. See you guys.
See you guys later.
You guys have a good night.
Bye.
All right, George, you can probably stop the recording now too.
Okay.
And then